Big three, it's time. 3 stocks, 3 charts, 3 trades. Ben Lichtenstein will take us through the charts. And here to take us through the trades is Scott Nations, president of Nations Indexes. Thank you both for being with us. I was just looking at the chart of the S&P 500, Scott. I know that's your first trade for us, and saw that high last Monday, the sell-off on Friday, only to see us lower now than we were last Friday. Your thoughts as you're considering how to trade this?
The S&P has been all over the road lately, and that's great for traders. We haven't had a lot of that if you're a trader recently. Unfortunately, it's all over the road for not very good reason, but that's sometimes what it takes to torpedo the S&P. Nicole, so when I was on last time, I think I described myself as a scared bull. Well, now I'm kind of just scared, even though the S&P is up about 50 handles today. So the first trade I would do is I would buy a little protection, general protection in the S&P 500. The way to do that, and you can actually do this probably at better levels than I put together here, but the way to do that, at least till the end of the year, is to buy a put spread on SPY, the big S&P ETF. Specifically, I would buy in the December 31st expiry. And so that's through the end of the year. I would buy the 450, 430 put spread. How do we do that? We buy the 450 put, and when I put this together, we could do that at about $10.35. We reduce the cost of the whole thing by quite a bit by selling a 430 put at $7.50. So again, prices that were in the market when I put this together, we'd be paying $4.85. For a spread that's 20 handles wide, that 485, that's our max risk. Our max profit would be $15.50. And we would realize that with SPY below 430 at that expiration. The interesting thing here, the way to look at spreads, at vertical spreads like this is how much of the spread width are you paying? And in this case, we're paying less than 25% of the width of the spread, even though we're fairly close to at the money. So I would put that on. And Nicole, this is kind of like life insurance. If it doesn't pay off, I can't really be that unhappy.
I understand. Okay, you're like Jay Powell. He's moving away from the word transitory. You're moving away from the word bullish. Ben, tell me your thoughts.
Well, good morning, guys. It sounds like Scott's still somewhat cautious, though, and I can see why. Because, again, some of the weakness we've seen, we really have yet to slow the momentum to the downside or any indication as of yet that we're starting to build a bottom here at this point. The market still continues to come under pressure, and today, really the weak link in the chain being the NASDAQ, but the SPY, a reflection of some of the concerns that investors have been feeling over the last week or so as we've recently come off all-time highs. And I think the more intraday kind of sums it up in terms of some of the selling that we've seen off the highs from last week recently. And the move from 473 down to 453. Here you can see how, there hasn't really been much in terms of rejection of this lower level. We kind of just double bottomed here yesterday and this morning, but we really haven't taken out anything that was established on the way down in terms of this move yet. So again, it looks like just a little bit of consolidation here. We're testing the upper extreme of the range that we've been in for the most part today and, throughout the middle of the day yesterday into this. But you can see that, throughout the month of October, we ran them up in a big way, and then November, it just basically went sideways, and now we're starting to leak lower again. Still holding above the November low, I want to point out. So we did not take that low out here in terms of actually, the November low here is what we're on right now. So again, it is starting the month off on there. But I want to point out here also that the channel to the upside has been well defined. Again, you can see that we're kind of working our way towards the lower extreme of that. And then just on the weekly time frame, pointing to the unsustainability of this move to the upside. So I think a pullback at this point could be healthy. I just don't see it necessarily stopping on a dime as of yet.
And Scott, That's what you talked about trading. Ben used the word healthy. And that's what traders want. I mean, they just don't want up and away, because then they know valuations are probably, mispriced or too frothy. I was just looking back at the chart, and, I love 47.43 back last Monday. It feels so far away at this point. So you feel that you're comfortable with something like this trade more so at this point, more of a hedge, I guess?
Certainly more of a hedge, maybe a little bit of a speculation. But Nicole, the price action in the last half of the day yesterday was just absolutely terrible for the S&P, actually for all of the equity indexes. And that's another reason that I'm scared. Again, S&P doing really well today, but if we were to see some sort of repeat of the horrible price action yesterday, then what does that tell people? It doesn't tell them to be optimistic.
Right. Okay. So let's get now over to the financial world, right? We look at JPMorgan, which, it's definitely been somewhat of a choppy trade, but the trend has been higher. So on any given day, you can see that it's been recently lower. But as you look at a 1-month chart, a 3-month chart, a year-to-date chart, or a 1-year chart, you're up 30% in 1 year. This choppy trading could give you, Scott, some opportunity to make some money. Tell us more.
Yeah, I'm a little scared, as I said before, but we know that stocks go up over time, and great stocks do really well. And listen, in the financial sector, JPMorgan is the best name. And again, it's gotten a little bit away from me this morning, but I would love to be able to buy JPMorgan on a little bit of a pullback. We have kind of that opportunity here. And I think that while we're seeing lower rates right now because of all the volatility in the broad market, once we do get higher rates sustainably, JPMorgan's going to be able to take advantage. So I want to be just a buyer of JPMorgan. Again, when I put it together, it was 159.40. Again, it's gotten away from us a little bit. So if you wanted to buy lightly at current levels of about 161.25, then you could do that. I would probably buy a little bit. I would probably buy half the size, half of a unit instead of a whole unit. I would have bought lower. But Ben's going to look at the chart, and you're going to see a bunch of higher highs and higher lows, even though it's pulled back a little bit. I think it's just a really healthy story all the way around. Right.
So the higher highs and the higher lows, Ben, and that's a key trend.
Scott, I think what Scott's talking about here is actually very bullish in many ways. The inability to get it at lower levels, for one, the fact that it's rallying as we talk about it here, I think is important. And why? Because we're coming off a key level that the bulls want to see hold, and I'll show you why when we look at the bigger picture. But first and foremost, the intraday, and well, it has been a bit of a chop as of recent. There hasn't been a lot of conviction here. You can see, for the most part, really rotational this week, mostly around this 161 level. But you've got 157 being the lower extreme, and you've got the upper extreme being this 165 area. Quick step into the 30-minute time frame, the hourly, shows that, well, since the end of October, when we were trading up around this 172 level, it's been, for the most part, nothing but to the downside, down to 157 recently, and it does look like we just posted, well, potentially a bit of a double bottom there. Now, I want to point out, still up 28% year to date, so while off those recent highs up around 172, but the bulls want to see this 160 area hold right in this range here, because what I'm starting to see is kind of these two areas of consolidation formed. One, again, throughout, well, this spring, we're talking into the run-up that we saw late August into September. And then there's been this one that's been kind of forming right around this area. Now, if we get below 155-ish, well, quick look here at the weekly or the daily and longer term here shows that, well, the lower extreme of the most recent range that we formed would be down around this 147, 145 area. So again, I want to see the bulls, I should say, would want to see this key area here around 155 hold. If not, it opens up a door, potential retest of the 145 area. But again, with that double bottom that we just recently saw, it does look like they're trying to build some momentum to the upside. Quick, lastly, look at the weekly time frame. This does look like, again, it might be a larger range forming here, but the bulls trying to get something going here, trying to end this 6-day slide. I'm sorry, 6 week
the
slide.
thing. I mean, people, exactly. Thank you for that. And so, Scott, as we take a look here, and everybody's keeping interest rates in mind, And even just the fluctuation we've seen in interest rates makes it hard to be a trader too, because, you know, every time you think they're heading higher, then we were down below 1.5. We were closer to 1.7 at one point. Final thought on JPMorgan, Scott.
Well, I think Ben did a wonderful job of showing the different time frames. When I said higher highs and higher lows, I was obviously meant a longer time frame. But, you know, Ben did a great job. And so maybe there's something for everybody in JPMorgan. If you really want a short-term trade, then you can go in one direction. But I'm looking for a little bit longer-term trade. Ben did a great job of pointing out the different time frames.
Yeah, well, that's the point. And we understood what you meant, Scott. We knew what you meant when we said higher highs and higher lows. That's why I said if you look 1 month, 3 month, year to date, or 1 year, that it was higher. And we both noted that, and Ben noted that as well in his year to date comment. Let's move on to the third and final trade here, and that is all about natural gas. And you're doing some speculation, maybe about some stay at home, a little less travel, which is becoming increasingly difficult. Tell me about your natural gas trade, Scott.
Right. Now, listen, we're locking down again. There's the potential for even more onerous lockdowns because of the Omicron variant. And I understand why. We're not going to get past this entire pandemic until we're done with a new variant every few months. But what does that mean? Well, it means that travel is going to have a really tough time because we're going to stay indoors again. But Nicole, in Chicago, it's starting to get cold. It's December. And so that should be very bullish for natural gas, which has already had a really nice run. But it should be very bullish for natural gas. And you could trade options on the futures. I'm going to talk about trading options on, as you see there, UNG, which is the natural gas ETF. Now, I'm talking about speculation, but, you know, when we're speculating, we're not trying to throw darts at a dartboard. I want to speculate in a situation where I have a solid fundamental understanding of what's likely to be moving the market. But the way to speculate, I think, in UNG is to simply buy a call option. To buy a call option because I think that the lockdown, Omicron variant, is going to be really bullish for natural gas. The way to do this is to buy the 16 strike call expiring in January. So that'd be January 21st of next year. Again, 16 strike call. When I put this together, you could buy that for 75 cents. Again, we don't want to just speculate heedlessly, but this is one of those things where we're paying 75 cents, not a lot of money for a call that could really explode. And given the lockdown and where we are on the calendar and what the weather's going to look like between now and, say, the middle of January, I think this is one of those trades that could really pay off.
Right, and it makes sense. I mean, we're speculating what people may or may not do, but there's certainly a lot of thought behind that. Even the fireplace, right? I'm being funny, but even a fireplace, a gas fireplace, could use either natural gas or propane. I know there's differences in those charges and how they run, but you're right. People are going to be home, and that'll be something. Ben, tell us more about UNG.
Well, similar to the SPY, a little bit of weakness as of recent, to say the least, and no indication that that is ended as of this point yet. So it's kind of like catching a falling knife, I think. Scott, I do agree with what he said in terms of the fact that, yes, it's December. There are a lot of bullish factors for natural gas. We saw a draw on inventories this morning from the EIA, basically in line with expectations, but the second draw only since March. So we're starting to come into clearly that heating season. But the calendar, Scott, says December, but go outside right now. I think it's 55 degrees out there. It's a balmy 55. So you can see why prices have come off as of recent in UNG and natural gas futures for that matter. This is a quick look at the 5-minute time frame, some of the selling we've seen. And again, just no indication that that's ended as of yet. We're kind of holding around this $13.50, $14 level, but mostly sideways. I want to see, before I get really excited about this one and think it's starting to bottom, I want to see it start to take out some of the areas, these areas of consolidation that were established on the way down. As of yet, we've yet to see that again. Here's another look at, well, the most recent breakout into the end of November and down and through the $16 level. We had been sideways. So this is, again, just a value-seeking move lower, and we have really yet to even establish that, it seems like. Quick look at the daily time frame shows the slide. We've seen how this move that we were just looking at into this $14.50, $14 level, well, it's just part of the bigger picture move off 22. So again, tough for me to get excited about this one as it's headed south, but certainly if we were to see a bottom form with all of the fundamentals that Scott spoke to in terms of the bullish factors that I want to stress he said could come into play here, they certainly has not as of yet. Try and say that 10 times fast. But yeah, I'm waiting to see some strength here before I get excited about this one or before I'm willing to call a bottom at this point.
Yeah, thank you both so much. We'll leave the tongue twisters to you, Ben. Thank you both very much, Ben Lichtenstein and Scott Nations with the trades of Nations indexes. We appreciate it very much. Thank you both.